November 15, 2024. Beijing, China. The People's Bank of China releases its monthly reserve data. Buried in the technical report is a single line. U.S. Treasury holdings decreased by $21 billion in October. The same day, Tokyo. The Bank of Japan publishes its own data. Treasury holdings down $18 billion. Individually, these numbers mean nothing. Central banks adjust portfolios constantly. But when you zoom out, when you track the pattern over 24 months, a different picture emerges. Since January 2023, China has sold $310 billion in U.S. Treasuries. Japan has sold $287 billion. Combined, that's $597 billion. Nearly $600 billion in just under 2 years. And they're not stopping. By the time you finish watching this video, another $50 to $100 million in treasuries will have been sold. By the end of 2025, the total will exceed $1 trillion. This isn't portfolio rebalancing. This isn't profit-taking. This is the two largest foreign holders of U.S. debt systematically, quietly, month after month, exiting the treasury market. And almost nobody is talking about it. Here's what most people don't understand. China and Japan aren't just big treasury holders. They are the treasury market. Together, they hold $2.1 trillion, 28% of all foreign-held U.S. debt. When they sell, there is no market. There's only one buyer left, the Federal Reserve. And when your central bank becomes the only buyer of your government's debt, you're not a superpower anymore. You're Venezuela with better PR. This is the most important financial story happening right now, and it's invisible because it's happening in monthly data releases that no one reads. Let me show you the complete timeline of how we got here. The specific trigger that made China and Japan start selling simultaneously. The exact mechanism by which they're selling forces the Federal Reserve to print money. What they're buying instead of treasuries. And what happens when the math breaks completely. When the Fed is buying 80% of new treasury issuance because no one else will. Because this isn't about China and Japan. They'll be fine. This is about what happens to America when the two countries that financed your deficits for 40 years decide they're done. The free lunch is ending. And the bill is $1 trillion and counting. Before I show you what's happening now, you need to understand what normal looked like. From 1980 to 2020, the U.S. China-Japan relationship was the most important economic triangle in the world. It worked like this. 1. America imported Chinese goods and Japanese cars. Trade deficits. $350 billion with China, $70 billion with Japan annually. 2. China and Japan accumulated dollars from exports. They needed somewhere to park those dollars. 3. They bought U.S. treasuries. Safe, liquid, yielded interest. This created a closed loop. America printed dollars. China and Japan took those dollars and bought American debt. America used that borrowed money to buy more Chinese and Japanese goods. Repeat. The system had a name. Bretton Woods II, the unofficial arrangement that let America run infinite deficits because China and Japan would always recycle dollars back into treasuries. By 2013, this system reached its peak. China held $1.32 trillion in treasuries, the record. Japan held $1.24 trillion in treasuries, also near record. Combined, $2.56 trillion. Over 30% of all foreign-held U.S. debt. Think about what this meant. Two countries, neither of them allies in the traditional sense, were financing 1/3 of America's foreign debt. The U.S. government could spend $1 trillion more than it collected in taxes, and China and Japan would buy the bonds to cover the difference. This was the foundation of American power. Not the military. Not Silicon Valley. The ability to borrow unlimited amounts at 2 to 3% interest rates because the world's two largest surplus nations had no choice but to buy your debt. That system is ending. And it's ending quietly, systematically, and irreversibly. Phase 1. China's slow exit, 2013 to 2021. China's treasury holdings peaked in November 2013 at $1.32 trillion. Then they started falling. By 2021, China held $1.07 trillion. That's a $250 billion reduction over 8 years. About $30 billion per year. Gradual. Manageable. Not alarming. Why was China selling? 3 reasons. First, China's trade surplus with the U.S. was shrinking. Fewer exports equals fewer dollars to recycle equals fewer Treasury purchases. Second, China was diversifying reserves. The People's Bank started buying more gold, more euros, more IMF special drawing rights. Standard reserve management. Third, China was preparing for conflict. After 2016, U.S.-China relations deteriorated. Trade war. Tech war. The Chinese Communist Party asked a simple question. What happens to our $1 trillion in treasuries if we invade Taiwan? The answer was obvious. America would freeze them. Just like Russia's reserves in 2022. So China began reducing exposure. Slowly. Quietly. $30 billion per year. This was Phase 1. Defensive diversification. Phase 2. The acceleration, 2022 to 2023. Then, February 2022 happened. Russia invaded Ukraine. Within 72 hours, the United States, EU, and UK froze $300 billion in Russian central bank reserves. In Beijing, this was the confirmation. The question wasn't, would America freeze our reserves? Anymore. It was, when? In March 2022, China held $1.04 trillion in treasuries. By December 2023, China held $782 billion. That's a $258 billion drop in 21 months. $12 billion per month. The selling rate tripled. But Japan was still buying. Japan is a U.S. ally. Japan hosts 50,000 American troops. Japan wasn't worried about freezing. So Japan kept buying treasuries, hitting a record $1.32 trillion in early 2022. Japan was the reliable buyer. The last pillar holding up the system. Phase 3. Japan breaks, 2024 present. Then April 2024 happened. The G7 announced they would seize the interest on Russia's frozen $300 billion and transfer it to Ukraine. This wasn't freezing anymore. This was confiscation. And Japan watched. Japan's finance ministry held an emergency meeting. The question wasn't about geopolitics. It was about math. Japan holds $1.1 trillion in treasuries. But Japan's own debt is 260% of GDP, the highest in the world. Japan needs to borrow $500 billion per year just to refinance existing debt and fund deficits. Here's the problem. Japan was funding its own borrowing by selling treasuries. When the Bank of Japan needs yen, it sells dollar assets, treasuries, and converts to yen. As long as treasury yields were low, 1 to 2%, this worked. But in 2022 to 2024, the Federal Reserve raised rates from 0% to 5.5%. Suddenly, the treasuries Japan bought at 1% yield in 2020 were worth 30% less. Japan was sitting on massive unrealized losses. And then Japan saw what America did to Russia's reserves. The calculation became clear. We hold $1.1 trillion in treasuries. We're sitting on $200 billion in losses. America just showed it will confiscate reserves for political reasons. Why are we still holding these? In April 2024, Japan held $1.13 trillion. By November 2024, Japan held $1.02 trillion. That's $110 billion sold in 7 months. $15 billion per month. Japan wasn't just selling to fund its own borrowing anymore. Japan was exiting. The combined effect. Let me show you the math. China's selling rate. 2013 to 2021. $30 billion per year. 2022 to 2023. $144 billion per year. 2024 present. $180 billion per year. Japan's selling rate. 2020 to 2023. Buying $50 billion per year. 2024 present. Selling $200 billion per year. Combined rate of change. Before 2024, China selling $144 billion per year, Japan buying $50 billion per year equals net $94 billion selling. After 2024, China selling $180 billion per year, Japan selling $200 billion per year equals net $380 billion per year selling. That's a $430 billion swing in annual demand. And it's accelerating. By December 2024, combined China-Japan Treasury holdings stood at $1.98 trillion, down from $2.56 trillion peak. That's $580 billion sold. At current rates, by December 2025, combined holdings will be $1.6 trillion. That's $960 billion sold since peak. $1 trillion. Almost exactly. Here's what happens when China and Japan sell $380 billion in treasuries per year. 1. They place sell orders. China calls primary dealers, J.P. Morgan, Goldman Sachs, B of A, and says, "We're selling $15 billion in 10-year treasuries." Japan does the same. 2. Primary dealers try to find buyers. The dealers call domestic buyers. Pension funds, insurance companies, mutual funds. Anyone want $15 billion in treasuries? Problem. Domestic buyers already hold $9 trillion in treasuries. They are maxed out. They are not increasing exposure. 3. Primary dealers are forced to buy. Primary dealers are contractually obligated to make markets in treasuries. If there are no other buyers, they must buy. So the dealers buy. Now they're holding $30 billion in treasuries they don't want, at yields they don't like, with capital they need for other business. 4. Dealers dump to the Federal Reserve. The dealers can't hold forever. So they sell to the only buyer with infinite capacity. The Federal Reserve. The Fed officially ended quantitative easing QE in 2022. The Fed claims it's reducing its balance sheet through quantitative tightening QT. But look at the actual data. Fed Treasury holdings. January 2023, $5.0 trillion. January 2024, $4.8 trillion, down $200 billion, QT working. November 2024, $4.9 trillion, back up $100 billion. The Fed is buying again. Why? Because primary dealers are choking on unsold treasuries from China and Japan selling. 5. The Fed prints money to buy treasuries. When the Fed buys treasuries, it doesn't use existing money. It creates new money. Digital entries. Expansion of the monetary base. This is textbook monetization. The central bank printing money to buy government debt. Here's the death spiral. China/Japan sell $380 billion per year. No private buyers. Fed buys $380 billion per year. Fed prints $380 billion in new money. New money causes inflation. Inflation makes treasuries less attractive. Real returns go negative. More foreign holders want to sell. Return to step 1 but with higher selling volume. This is how reserve currencies die. Not with a bang. With a monthly data release showing another $20 billion sold. When China and Japan sell treasuries, where does the money go? China's allocation. Gold. China officially reported buying 225 tons of gold in 2023 to 2024. Unofficial estimates, based on import data, suggest 400 plus tons. At $2,000 per oz, that's $25 billion in gold purchases. Why gold? Because gold held in Chinese vaults can't be frozen. Russia's gold in Russia was never touched. Only Western reserves were frozen. Commodities. China is stockpiling strategic commodities. Oil reserves hit record highs in 2024. Copper, lithium, rare earths. All being accumulated. Belt and Road lending. China is lending dollars to developing countries in Asia, Africa, and Latin America. These loans are denominated in yuan or come with yuan payment options. This builds the yuan's international role. CIPS infrastructure. China is investing in its cross-border interbank payment system, CIPS, the alternative to SWIFT. CIPS processed $27 trillion in 2023, up from $12 trillion in 2020. Yuan-denominated bonds. China is buying bonds issued by other countries in yuan. Saudi Arabia issued yuan bonds. Argentina issued yuan bonds. These are alternatives to treasuries. Japan's allocation. Japanese government bonds. JGB's Japan is selling treasuries to buy its own government bonds. Japan's debt to GDP is 260%. The Bank of Japan needs to keep yields low or the government goes bankrupt. So Japan is using dollar reserves from selling treasuries to buy yen, then using that yen to buy JGBs. Japan is financing itself instead of financing America. Gold. Japan increased gold reserves by 15 tons in 2024. Small but directionally significant. Japan hadn't bought gold in a decade. Euro and other currencies. Japan is diversifying into euros and Swiss francs. Still Western currencies, but not dollars. The pattern is clear. Away from dollars. Away from U.S. political risk. Toward hard assets and domestic financing. Let me show you the math that proves the system is breaking. U.S. government borrowing needs. Annual. New deficit. $2 trillion. Refinancing maturing debt. $5 trillion. Total annual issuance. $7 trillion. Who buys this $7 trillion? Before 2022, normal market. Foreign buyers. 30% equals $2.1 trillion. Domestic private. 50% equals $3.5 trillion. Federal Reserve. 20% equals $1.4 trillion. This was sustainable. The Fed was a minority buyer. After 2024, breaking market. Foreign buyers. Minus 5% equals minus $350 billion. They're net sellers. Domestic private. 50% equals $3.5 trillion unchanged. Federal Reserve. 55% equals $3.85 trillion. The Fed has gone from 20% to 55% of the market. Let me repeat that. The Federal Reserve is now funding 55% of U.S. government borrowing when you account for foreign selling. When your central bank is financing over half your deficit, you have a failed state budget, not a superpower budget. Projection for 2025 to 2027. If China and Japan continue selling at current rates. 2025. Foreign sellers dump $400 billion. 2026. Foreign sellers dump $450 billion as others join. 2027. Foreign sellers dump $500 billion. The Fed's share increases. 2025. Fed buys 60% of new issuance. 2026. Fed buys 65%. 2027. Fed buys 70%. At 70%, you're not a market anymore. You're a Ponzi scheme where the government borrows from itself. Based on historical patterns and current trajectories, here's what happens. 2024 to 2025. The quiet phase, we are here. China/Japan selling $380 billion per year. Other countries, Saudi, Taiwan, Korea, watching but not panicking. Fed absorbing selling through temporary operations. Treasury yields stable at 4 to 5% because Fed is suppressing them. Mainstream media not covering story. 2025 to 2027. The awareness phase. Combined China/Japan selling crosses $1 trillion total. Other major holders, Taiwan $200 billion, Korea $100 billion, Saudi $90 billion, begin selling. Total foreign selling hits $600 billion per year. Fed holdings exceed $6 trillion, 25% of all treasuries. Financial media starts covering foreign treasury dump. Treasury yields start climbing despite Fed buying. 5%, 6%. 2027 to 2030. The crisis phase. Foreign holdings fall below $6 trillion from $7.5 T peak. Fed holdings exceed $8 trillion, 30% of all treasuries. Treasury auctions start failing. Primary dealers refuse to bid at offered yields. Yields spike to 7 to 8% on long-term bonds. U.S. interest payments on $45 trillion debt hit $3 trillion per year. Interest becomes largest budget item, exceeding Social Security. 2030 to 2035. The breaking phase. Fed owns 35 to 40% of all treasuries. Yields at 8 to 10% despite Fed buying, inflation premium built in. Dollar loses 20 to 30% of value against basket of currencies. Inflation runs 6 to 8% annually despite high interest rates, stagflation. Foreign treasury holdings below $5 trillion. Discussion of restructuring U.S. debt begins. 2035 to 2040. The post-dollar phase. Dollar no longer dominant reserve currency. Share below 40%. Treasuries no longer risk-free asset. U.S. forced to balance budget or face hyperinflation. Yuan, euro, gold-backed digital currencies share reserve status. American living standards adjust downward 20 to 30%. This timeline assumes no acceleration events. But acceleration is likely. Possible triggers. Taiwan invasion. China dumps remaining $780 billion instantly. Major U.S. bank failure. Foreign confidence breaks. Fed unable to control inflation. Treasury holders panic. Debt ceiling crisis where Congress refuses to raise limit. Credit rating downgrade to AA or A+. Any of these compress the 15-year timeline into 5 to 7 years. Let me show you exactly who profits and who gets destroyed. Winners. China, strategic winner. China is selling $780 billion in treasuries at 4 to 5% yields before they collapse. China is buying. Gold at $2,000 per oz will be $5,000 plus by 2030. Commodities at current prices will double. Yuan infrastructure, CIPS, bilateral trade deals. When the dollar loses reserve status, the yuan gains by default. China is positioning to be the next financial hegemon. Gold holders, massive winner. Central banks are buying 1,000 plus tons of gold annually. This demand alone pushes prices from $2,600 per oz today to $5,000 to $7,000 per oz by 2030. Anyone holding physical gold multiplies wealth 2-3x while dollar assets collapse. Hard asset holders, commodity winner. Oil, copper, agricultural land, real estate in stable countries. All appreciate in dollar terms as the dollar weakens. Debtor nations with dollar debts, conditional winner. If the dollar weakens 40 to 50%, debts denominated in dollars become easier to repay. Argentina, Turkey, others benefit. Losers. American Treasury holders, catastrophic loser. $36 trillion in outstanding treasuries. When yields go from 4% to 8%, existing bonds lose 30 to 40% of value. Who holds these? Domestic pension funds. $4.5 trillion, $1.5 loss. Insurance companies. $2 trillion, $700 billion loss. Banks. $5 trillion, $1.7 loss. Individual investors. 401ks. IRAs $1 trillion, $350 billion loss. Total domestic losses. $4.25 trillion. Japan, reluctant loser. Japan holds $1 trillion in treasuries. Even selling now, Japan will lose $200 to $300 billion on unrealized losses from bonds bought at 1 to 2% now worth 50 to 60% of par value. Japan is escaping a sinking ship but still getting wet. U.S. government, operational loser. With interest rates at 8%, debt service on $45 trillion costs $3.6 trillion annually. Current federal revenue, $4.5 trillion. That means 80% of all taxes go to interest. Nothing left for military, Social Security, Medicare. The government must either default on obligations, cut spending 60%, print money and accept hyperinflation. All three options destroy credibility. American consumers, living standard loser. For 40 years, Americans consumed more than they produced because China and Japan financed the difference. When that financing ends, imports become 30 to 40% more expensive. Inflation runs 6 to 8% for a decade. Real wages fall 25 to 30%. Living standards return to actual productive capacity. The middle class discovers what post-empire means. American retirees, existential loser. Social Security, Medicare, pensions, all paid in dollars. When the dollar loses 40% of purchasing power, your $2,000 monthly check buys what $1,200 buys today. Retirees on fixed incomes are destroyed by inflation. Could China and Japan reverse course and start buying treasuries again? No. Here's why. Reason 1. Trust is broken. China and Japan saw what happened to Russia's $300 billion. They saw the April 2024 seizure of interest. They know U.S. law, International Emergency Economic Powers Act, allows the president to freeze any foreign assets by declaring an emergency. They can't unsee this. They can't unknow that their treasuries are hostage to U.S. foreign policy. Reason 2. Structural trade changes. China's trade surplus with the U.S. is shrinking. From $350 billion in 2018 to $280 billion in 2024. Less surplus equals fewer dollars equals less need for treasuries. Japan's trade with the U.S. is also declining as Japan trades more with Asia. Without trade surpluses, there's no structural reason to accumulate treasuries. Reason 3. Alternative systems exist now. In 2010, there was no alternative to treasuries. Today, CIPS processes $27 trillion, alternative to SWIFT/dollar system. Yuan oil contracts exist, Shanghai Petroleum Exchange. Gold is liquid and accessible. Eurobonds, Swiss bonds available. The alternatives didn't exist 15 years ago. Now they do. Reason 4. Domestic political pressure. In China, holding $1 trillion in U.S. treasuries while the U.S. threatens war over Taiwan is politically untenable. In Japan, holding $1 trillion in treasuries while sitting on massive losses is fiscally irresponsible when Japan needs to finance its own debt. Both countries face domestic pressure to sell, not buy. Reason 5. The Fed can't stop. The Federal Reserve is trapped. If the Fed stops buying treasuries to let the market clear, yields spike to 8 to 10%. Treasury market crashes. Regional banks fail, they hold dollar trillions in treasuries. Recession/depression ensues. So the Fed must keep buying. But the more the Fed buys, the more it prints, the more inflation rises, the more foreign holders want to sell. There's no exit. The spiral only goes one direction. This has happened before. Britain 1914. World's dominant financial power. Pound sterling was global reserve currency. London was financial capital. Britain's mistake. During World War I, Britain froze German assets in London. After the war, neutral countries, Netherlands, Switzerland, Scandinavian countries, realized British banks weren't safe during conflict. They diversified away from pounds into dollars and gold. The timeline. 1914. Pound dominance peaks. 1920s. Gradual shift toward dollars. 1931. Britain forced off gold standard. Pound devalued 30%. 1944. Bretton Woods formally ends pound dominance. 1945 to 1960. Pound becomes secondary currency. From peak to replacement. 31 years. America 2022. World's dominant financial power. Dollar is global reserve currency. America's mistake. February 2022, froze Russia's $300 billion. April 2024 seized the interest. The timeline. 2022. Dollar dominance peaks. Russia reserves frozen. 2024. Selling accelerates. China/Japan dump $380 billion per year. 2027 to 2030. Dollar loses majority reserve status. 2035 to 2040. Dollar becomes one of several reserve currencies. 2040 to 2050. Yuan/gold-backed currencies dominant. From peak to replacement. 18 to 25 years. Faster than Britain because technology accelerates capital flows. We are in year 3 of that timeline right now. The mainstream narrative is, Foreign central banks are adjusting portfolios. This is normal reserve management. That's a lie. Here's how you know. Lie number 1. It's just profit-taking. If this were profit-taking, they'd sell when prices are high. But Treasury prices are down 30% from 2020 peaks. China and Japan are selling at a loss. That's not profit-taking. That's escape. Lie number 2. They need dollars for domestic reasons. China has $3.2 trillion in total reserves. They don't need to sell treasuries for dollars. They already have more dollars than they need. They're choosing to hold fewer treasuries. Lie number 3. This is normal volatility. Normal volatility is plus or minus $50 billion per year. $380 billion annual selling is 7x normal. This is a structural shift, not volatility. Lie number 4. The market is healthy. If the market were healthy, private buyers would absorb the selling. But they're not. The Fed is absorbing it. When your central bank is the market is dead. The truth is simple. China and Japan saw what happened to Russia and decided to exit before it happens to them. Every month, another $30 to $40 billion sells. Every month, the Fed prints another $30 to $40 billion to buy them. Every month, the death spiral tightens. And every month, the financial media says, nothing to see here. Here's what happens when China and Japan sell $1 trillion in treasuries and the Fed becomes the only buyer. Outcome 1. Higher interest rates despite Fed intervention. The Fed can buy treasuries, but it can't control inflation expectations. As inflation rises from money printing, bond buyers demand higher yields to compensate. Expect 10-year Treasury yields at 6 to 8% by 2027 to 2030, even with Fed buying. Outcome 2. Weaker dollar. As the Fed prints $400 to $600 billion annually to absorb foreign selling, the monetary base expands. More dollars equals less value per dollar. Expect dollar loses 30 to 40% against strong currencies, Swiss franc, Singapore dollar, by 2030 to 2035. Outcome 3. Persistent inflation. Money printing causes inflation. The Fed can raise interest rates to fight inflation, but that makes Treasury debt service costs explode. The Fed is trapped. Expect 5 to 7% inflation for 5 to 10 years versus 2% target. Outcome 4. Failed Treasury auctions. When the Fed is buying 70% of issuance, the remaining 30% becomes hard to sell. Primary dealers start refusing to bid. Auctions fail. Expect first true auction failure by 2027 to 2029. Treasury forced to offer 8 to 10% yields to attract buyers. Outcome 5. End of American fiscal dominance. Without cheap borrowing, the U.S. can't run $2 trillion deficits. Forced austerity. Cuts to military, Social Security, Medicare. Expect, by 2035, U.S. either balances budget or faces currency crisis. These outcomes are inevitable because the math doesn't work anymore. You cannot have $2 trillion annual deficits. Foreign buyers selling $400 billion per year. Domestic buyers tapped out. Fed buying 60 to 70% of issuance. Low interest rates. Stable currency. Something has to give. And what gives is American financial dominance. When the dollar loses reserve currency status, what replaces it? Scenario 1. Yuan dominance, 30% probability. China's economy surpasses the U.S. by 2030. CIPS becomes dominant payment system. Oil trades in yuan. Central banks hold yuan bonds. Problem. Yuan has capital controls. Not freely convertible. Hard to trust. Scenario 2. Multipolar system, 50% probability. No single dominant currency. Dollar 35%, yuan 25%, euro 25%, gold/commodities 15%. Regional trade blocs use regional currencies. Asia uses yuan. Europe uses euros. Americas use dollars. This is most likely. No single country strong enough to dominate. Scenario 3. Gold-backed digital currency, 15% probability. BRICS nations launch gold-backed digital currency for trade settlement. Combines gold's trust with digital efficiency. If successful, becomes preferred reserve asset. Commodity exporters accept it for oil/metals. Scenario 4. Status quo limps along, 5% probability. Fed continues printing. Dollar slowly declines but maintains plurality of reserves through inertia. Least likely because math doesn't work. Can't print forever without hyperinflation. My prediction, Scenario 2, multipolar. By 2035 to 2040. Dollar remains largest single currency but not hegemonic. Loses exorbitant privilege. Let me end with this. China and Japan aren't selling $1 trillion in treasuries because they hate America or want to hurt the U.S. economy. They're selling because they did the math. They calculated, what's the probability our reserves get frozen in the next 20 years? For China, the answer was, if we move on Taiwan, 100%. For Japan, the answer was, we can't afford to hold negative yielding assets when we have our own debt crisis. So they're selling. Quietly. $30 billion per month. Every single month. For 2 years now. And the Federal Reserve is buying. Quietly. Printing money. Every single month. This is not a conspiracy. This is not a coordinated attack. This is two countries looking at the same risk and reaching the same conclusion. Get out. The November 15, 2024 data release showed China holdings $774 billion, down $21 billion from October. Japan holdings $1.02 trillion, down $18 billion from October. December data will show another $30 to $40 billion sold. January will show another $30 to $40 billion. And so on. By December 2025, the total will exceed $1 trillion since peak. That's not a statistic. That's a signal. The signal is, the two largest foreign funders of American deficits have decided to stop funding American deficits. And when your creditors leave, you're not a superpower anymore. You're a country that has to live within its means. For America, that adjustment will take 15 to 20 years and cost the middle class 25 to 30% of living standards. The $1 trillion they're selling is just the beginning. By 2035, combined China-Japan holdings will be under $1 trillion total, down from $2.56 peak. That's $1.6 trillion in lost demand for U.S. debt. The Federal Reserve will have to print $1.6 trillion to compensate. And that's when the math breaks completely. China and Japan are quietly selling $1 trillion in U.S. debt. And what it means is, the American century is ending. Not with war. Not with revolution. With a monthly data release showing another $20 billion sold. If this showed you that China and Japan are systematically exiting the Treasury market, that their $1 trillion in selling is forcing the Federal Reserve to monetize U.S. debt, and that this is the beginning of dollar reserve status collapse, then subscribe. Because the next video shows what happens when Treasury yields spike to 8 to 10% and the U.S. government can't afford to service $45 trillion in debt. The three options. Cut Social Security and Medicare by 60%. Print money and accept hyperinflation. Or restructure debt and default. All three destroy the American middle class. China and Japan are selling $1 trillion in treasuries. They're not the victims. You are. Position accordingly.